Welcome to our revision class today. We'll be focusing on the second chapter in the syllabus, that is accounting for assets and liabilities. We'll be revising the subtopic on bank reconciliation. Bank reconciliation. Bank reconciliation, as you are well aware, is a process that explains the difference between the bank balance as shown in the organization's bank statement as provided by the bank and the corresponding amount or balance shown in the organization's own accounting records at a particular point in time. So bank reconciliation helps us understand why there are differences between the bank statement as provided by the bank and the bank balance as provided by the organization's accounting records. As we also discussed in our lessons, previous lessons, in our normal lessons, we mentioned that ideally the bank statement as provided by the bank and the bank account as provided by the business are supposed to be in agreement, because these are accounts that are used to record similar transactions. But due to the reasons that we gave, there are various reasons that lead to differences arising between the two accounts. So bank reconciliation is a process that helps us to explain why there are differences between the bank statement as provided by the bank and the record of the business as provided by the bank account. So today we'll be looking at a past paper question. That is a question that was examined in May 2014. We'll be solving that question, and if you allow me to read it, the question reads as follows. You have recently been employed by Baraka Trading Enterprise as an accounts clerk. The accountant has presented you with a cash book which shows a credit balance of 45,600 and a bank statement with a credit balance of 237,700 for the month of April 2014. While checking the cash book against the bank statement, you noted the following discrepancies. Discrepancy number 1. One of the checks issued to Ujuzi Limited for 13,400 was not honored by the bank. The second discrepancy, a check for 50,000 shillings issued to one of the sales and marketing agents on 20th November 2013 was never collected since the promotion was cancelled. The third discrepancy, one of the debtors credited Baraka Trading Enterprise bank account with 17,500 shillings and an amount previously written off as a bad debt. Discrepancy number 3. One of the debtors credited Baraka Trading Enterprise bank account with 17,000 shillings 500, an amount previously written off as a bad debt. Another check for 10,500 was returned to Baraka Trading Enterprises marked account closed. On further scrutiny, it was found that the customer had been declared bankrupt. Discrepancy number 4. It was discovered that the accounts clerk had entered a receipt of 42,500 as payment. Another discrepancy, checks drawn by Baraka Trading Enterprise but not presented for payment amounted to 134,000, while checks not credited amounted to 57,500. Note number 6. The company received dividends from some of its investment for 10,500 shillings and total banking costs debited by the bank amounted to 7,400 shillings. Another discrepancy, that is number 7, a standing order for a loan repayment of 20,500 shillings and another for magazine subscription for 1,200 shillings were effected by the bank. Then we have our last discrepancy, number 8. The bank had erroneously credited Baraka Trading Enterprise account with 70,000 shillings that belonged to another customer at the bank. Required: 1. The adjusted cash book as at 30th April 2014. Second requirement, a bank reconciliation statement as at 30th April 2014. So as you can see, from this question, we've been provided with information. The first information is in regard to the balances, the balance of the bank statement and the balance in the bank account. We are told that the cash book showed a credit balance of 45,600. On the other hand, the bank statement shows a record of a credit balance of 237,700 for the month of April 2014. Remember, we said ideally these two balances are supposed to be the same because the bank statement and the bank account at the business record similar transactions. But due to certain reasons, you find that the two balances do not agree. They are not in agreement. That's why we prepare a bank reconciliation statement. And we say that a bank reconciliation is a process that explains the difference between the bank balance shown in an organization's bank statement as supplied by the bank and the corresponding amount shown in the organization's own accounting records at a particular point in time. In this question, the point in time is 30th April 2014. So, as the accounts clerk, you are expected to prepare the adjusted cash book and the bank reconciliation statement as at 30th April 2014. And that's what we are going to do. We are going first of all to prepare the adjusted cash book, or we normally call it the updated cash book.